And so we don't see a lot of competition with developers looking to buy these properties. We do see other hoteliers that might want to take them over and upgrade them and maybe, take them from a Hampton Inn to a Marriott or, get them rebranded. But we typically find that we're the best buyer. We're the best buyer for these assets, and the sellers want to work with us because we can pay a little bit more than that hotelier is willing to, because hotels are worth 3 to 5 times the revenue that they generate, whereas an apartment building is worth 7 to 12 times the revenue that it generates.
You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
And welcome. You are listening to and watching the Financial Survival Network. I'm your host, Kerry Lutz. Interesting person you're about to hear from. Interesting investment approach. I don't think you're going to find anything like it. Basically, what they're doing is taking small motels, hotels across the country, converting them to residential, affordable residential. When I think of affordable housing, this seems to be the way to go. It's a private approach. They're not taking government money to do it, and they can produce more units probably in a year than many of the housing authorities around the United States do in a decade. Name of the person that you're about to hear from is Ryan Sudeck. Ryan, it's great to have you on the show. So affordable housing, all we hear about is that, affordable housing, we don't have enough. Government's got to build more of it. But you seem to be offering a different approach.
Yeah, that's exactly right. Thanks for having me, Kerry. Your intro was spot on. We're shipping, 100 to 200 units at a time of affordable housing, naturally affordable housing. And it only takes us about 6 to 12 months once we buy a property till we can start renting it out to tenants. So we can get units to market and address the need a lot faster than any ground up developer could, or certainly, a government authority could.
Yeah, so you've gone from 1,100 units in 20 to 1,800 units last year. I assume that's pretty furious pace. I mean, just dividing by 3, you're doing 234 units a year. I assume that pace is increasing for 24.
It is, yeah. We're at about 2,500 units total right now. We've had some sales in the portfolio, but there's a lot of acquisition opportunities out there for us. And you kind of couple the distress in hospitality with the insatiable demand for the affordable housing, and we feel like we're onto something. So we see no shortage of opportunities, and our plan is to do about 10 to 12 projects per year, so that we can execute on them pretty well.
Well, I've got a place that you should definitely buy. It's in Kissimmee, Florida, right by Disney World. It's a welfare hotel, and I'm sure the neighbors would welcome you taking it over. And it's got a pool, parking, and I once had the misfortune of staying there when I fled from a hurricane, and there were guys with prison tattoos there. It was a scary place.
Yeah, I hope the city of Kissimmee can work with us on some of the change of use permitting and zoning. We've had some challenges breaking into that market, but we know it well. We're trying to do some work down the street in Orlando, and that is one of the biggest challenges with these conversions, because we're changing the use from a hospitality asset to a residential asset, and we have to. The jurisdictions and the zoning and permitting folks have to basically let us do that.
Yeah, but so. Is that considered an up zone or a down zone?
I would consider, we're moving it to its highest and best use. So I'd consider it an up zone. Usually we're not changing the underlying zoning for the property itself, because most jurisdictions won't allow for what's called spot zoning. But we're going to the city and we're asking them to change the definition of the zone to allow for residential use. There are other potential exception processes in states like Washington, where I live and where we're based as Sage. They've actually legislated effective June of 2025 that all commercial buildings can be zoned by right to residential. So there isn't, basically the local municipalities can't get in the way of it. And so it's a different approach than some other states. Some other states just roll out the red carpet to try to, get us through. And then in some other states, they've actually legislated to make these conversion projects a little bit easier.
Yeah, they really should, because, if you watch an episode of Cops, you could definitely find a lot of prospective properties there, because it seems like nothing good is happening in these rundown, low-life motels and bad parts of town and all that. And here you redo them, make them new, and you get like taxpayers in there.
That's exactly right. We've had some good success with this, especially in the Hosmer district of Tacoma. We bought 4 properties on one street, on Hosmer Street. Hosmer Street used to be responsible for 10% of all the murders in the state of Washington. Hosmer is in Tacoma, which is just south of Seattle, for those not familiar with the Northwest. And, since we've taken over these properties, we've eliminated violent crime. The police officers used to send 3 patrolmen for every call that was made from one of these properties. Now they only send 1. So it's a really unique opportunity where, we're kind of doing good, but it's also good business, right? The underlying fundamentals of the investment are pretty sound as well. So
like in Florida, a lot of these older rundown motels, they just knock them down and put up high rise, So I guess that's kind of your competition, the people that want to come in and knock them down and put up a residential tower.
Yeah, and there's fewer and fewer developers that are starting right now. I think permits, the difference between housing that's being created and housing that's being permitted has never been wider in history than it is right now. Just because inflation's been running rampant, the cost of labor, materials is so high, the cost of debt is so high, that a lot of ground up developers have just pulled out. And so we don't see a lot of competition with developers looking to buy these properties. We do see other hoteliers that might want to take them over and upgrade them and maybe, take them from a Hampton Inn to a Marriott, or, get them rebranded. But we typically find that we're the best buyer. We're the best buyer for these assets, and the sellers want to work with us because we can pay a little bit more than that hotelier is willing to, because hotels are worth 3 to 5 times the revenue that they generate, whereas an apartment building is worth 7 to 12 times the revenue that it generates. And so, there's a bit of an arbitrage in there. Obviously, there's a lot of hard work to capture their arbitrage, but it allows us to pay more than a hotel operator would.
Right. And so is there much competition for this out there? Are there other companies doing what you're doing?
Less than 10. I'd say they're doing it repeatedly. There have been some that have pulled out, some folks that unfortunately overpaid. And, we're kind of coming in to grab those assets at a discount. So I'd say there's really probably 3 or 4 groups that I'm aware of, including ourselves, that are trying to do this repeatedly, at scale in multiple markets.
Okay. Interesting. So how'd you wind up getting into this, by the way, Ryan?
Great question. My interest in real estate started at an early age. Growing up, my dad was a pilot, but had a small portfolio of real estate in my hometown of Medford, New Jersey. And so I spent the weekend swinging hammers and installing toilets and snaking drains with him. And when 9/11 hit, he lost his pension, took a big pay cut. And, I saw the insurance policy and the stability that investing in real estate gave to my parents. And so I always knew I wanted that one day. Fast forward, I went to college out on the West Coast, ended up having a corporate career in mergers and acquisitions, helping big companies buy smaller companies, worked for Amazon and Samsung and Redfin and a few, just to name a few companies, but then started building my own portfolio. On the weekends, doing a similar thing where, I bought a 6 unit and renovated it, then an 8 unit, then a 16 and a 30. Eventually, fast forward to 2020, and Sage Investment Group got started, and that's where I'm now the CEO. I was still working in my corporate job at the time, but I decided to move my properties into Sage in exchange for shares of our fund, and then just became a passive investor in real estate. I decided to outsource the hard work, to the folks at Sage, and ended up joining the company full time as CEO mid last year, so in mid 2023.
Very cool story. So hey, never look back. That's right. I think you said there's 70,000 of these like mom and pop motels around the country.
That's exactly right. Yeah, in markets that we're interested in, because we're looking for wage growth, population growth, and we're also looking for properties with about 100 to 200 units, because we want enough where we get economies of scale on management. We can have an on-site manager that, that's kind of governs the low end. And then on the high end, we don't want to ship too many studio units in any one market. So, we don't want to take over a 400 unit property and ship 400 units of studio housing, because that would oversaturate the market.
Right. Hey, are these units furnished, Ryan?
Typically not. We only have one of our 24 properties that is furnished. We're actually just starting to lease it now. And we're going to see how it goes. But typically unfurnished units, but they have full kitchens for folks.
Yeah. So what's the biggest challenge you see in this market?
I'd say there's probably 3 challenges. The first is working with the local municipalities that, need to basically approve our change of use of the buildings to give us the permits to, convert these properties. That takes a long time, on average, at least 6 months. And, some of those municipalities treat this differently. And, maybe they assess us impact fees because they think that we're going to use more city resources, whether that's, water or sewer or parks. And we have to work with them and educate them on, hey, these are fully amenitized properties. There aren't, families here, so we're not hurting the school system. And then we also have to work with them to figure out, what code they're going to hold us to, what code book they're going to hold us to. The energy codes are ever changing, and sometimes we get curveballs thrown at us, on what requirements we're going to be held to. So I'd say that's kind of challenge number 1. Challenge number 2 is just the development itself. It's certainly not easy to do the work that we do. We just started our 19th conversion project, so we certainly learned a lot along the way, both in the diligence period and also the process of doing the renovation. And then the third is just sources of capital. We're always out there raising equity to fuel our growth, and then also finding lenders to partner with to help secure the properties as well.
Interesting. You would think that most municipalities would be looking to upgrade the quality of the properties, and thereby, because I assume that after you get done with your your rehab, real estate taxes are going to go up a little bit.
They go up a lot of it. Now, the city loses the hotel tax revenue. And so I haven't actually done the math recently, on one of our projects to see what they net out to be. But certainly, we pay a lot more in property taxes after the renovation, because we see typically at least a 50% increase in value over what we pay between the acquisition and the development. But, it's usually at least double what the property was worth as a hotel.
Well, you'd think if a place is an in by 10, out by 2 type situation, most of those people are paying cash. I don't know that a lot of them don't even take credit cards, and nobody wants to leave a trail that they were actually in this place. So probably they're not getting their full ride on the hotel and resort tax that a county, like in Florida, it's like those are huge taxes too. They're 20% many places. Interesting business model. Obviously, you'll be busy with this for a long time to come, and we appreciate you coming on. Just to tell us, anybody who wants to connect with you, follow you, how do you do that?
Yeah, you can go to sageinvestment.com. You can book a meeting with me there. You can also email me at ryan@sageinvestment.group, where we've got a LinkedIn account. You can certainly follow us there as well.
Excellent. Well, there'll be a link in the show notes to this interview on financialsurvivalnetwork.com. So you just have to click it. You find out all about Ryan and Sage Investment Group and the fund. If you got a question for Ryan, shoot me an email, kl@kerrylutz.com. And while you're at the site, please sign up for your free newsletter. Ryan, been a pleasure. Thanks for stopping by.
Thanks so much for having me, Kerry.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.